Genius Act and the New East India Company, a transformative shift in currency systems. Overview. The concept of the Genius Act and its intersection with the evolving landscape of stablecoins signifies a future where traditional currency systems are challenged by digital currencies backed by stable assets. The emergence of the New East India Company, potentially a metaphor for entities leveraging these technologies, hints at a shift in global financial dynamics, particularly regarding the US dollar as a stablecoin and its implications for existing legal currency systems and national sovereignty. Understanding stablecoins. Stablecoins are digital currencies designed to maintain price stability by being pegged to a reserve asset, typically a fiat currency like the US dollar. Unlike cryptocurrencies such as Bitcoin, which are subject to significant price volatility, stablecoins offer a predictable value, making them appealing for various financial applications. The most notable stablecoins include USDC issued by Circle, USDT Tether, and others which have gained traction in areas like cross-border payments, treasury management, and merchant settlements. The Genius Act, legislative framework. The Genius Act represents a legislative effort in the United States aimed at regulating stablecoins, ensuring their integration into the existing financial ecosystem while addressing potential risks. This act aims to provide a clear framework for stablecoin issuance, reserve management, and consumer protection. The U.S., however, faces a fragmented regulatory environment where stablecoin regulation varies from state to state, contrasting with the more unified approach seen in the European Union's markets in crypto assets MiCA regulation. Key events leading to legislative progress. 1. July 16, 2025, a procedural delay in the House of Representatives stalled the passage of several cryptocurrency bills, including the Genius Act. A coalition of Republicans and Democrats prevented the legislation from advancing, highlighting the complexities of bipartisan support for cryptocurrency regulation. 2. Late July 2025, following intervention from President Trump, discussions resumed to advance the Genius Act. Trump emphasized the importance of establishing the U.S. as a leader in the cryptocurrency space, advocating for swift passage of the legislation ahead of the August recess. Impact on the financial landscape. As stablecoins continue to grow in adoption, they challenge traditional banking systems and legal currency frameworks. The integration of stablecoins into financial systems can potentially disrupt existing payment rails by offering several advantages. Speed and cost efficiency. Stablecoins facilitate faster transactions with reduced fees compared to traditional banking systems. Cross-border payments can be settled in minutes rather than days, lowering remittance costs significantly. Programmability and automation. The programmable nature of stablecoins enables automated transactions through smart contracts, reducing the need for intermediaries and streamlining treasury management. New business models. Companies leveraging stablecoins can create innovative financial products, enhancing liquidity management and enabling real-time payments across borders. Common themes and differences in perspectives. Various stakeholders highlight common themes and concerns surrounding the rise of stablecoins and the Genius Act. Integration into traditional finance. There is a consensus that stablecoins serve as a bridge between traditional finance and digital assets, but regulatory clarity is essential for mainstream adoption. Risks and compliance. Concerns about regulatory compliance, operational risks, and the need for transparency in reserve management remain prevalent. Stakeholders emphasize the importance of robust oversight to build consumer trust. Future outlook. Experts predict that as regulatory frameworks solidify, stablecoins will increasingly play a foundational role in payment systems, corporate treasury operations, and cross-border transactions. The New East India Company, implications of a digital economy. The metaphorical reference to a New East India Company suggests that entities leveraging stablecoins may gain significant influence over global trade and financial systems, reminiscent of the historical East India Company's dominance in colonial trade. This scenario raises questions about the sovereignty of nations and the potential for digital currencies to reshape economic power dynamics. As stablecoins gain traction, they could challenge the US dollar's dominance, particularly in regions with unstable currencies or restrictive banking systems. The ability to transact in a stablecoin format may provide businesses and individuals in these regions with a reliable alternative, fostering economic inclusion and potentially undermining traditional financial institutions. Conclusion: a pivotal moment for financial transactions. The interplay between the Genius Act and the rise of stablecoins marks a critical juncture for the future of financial transactions. As regulatory frameworks evolve and adoption accelerates, the implications for existing currency systems and national forms will be profound. The outcomes of the Genius Act alongside the growth of stablecoins can redefine economic interactions, globally challenging established norms and paving the way for innovative financial ecosystems. In this transformative landscape, the actions taken by regulators, businesses, and consumers will shape the trajectory of digital currencies and their role in the global economy. The future of finance is at the intersection of innovation and regulation, and the path forward will require careful navigation of the opportunities and challenges presented by this new digital frontier. The topic of the Genius Act and the emergence of stablecoins, particularly in relation to the new East India Company, presents several counterintuitive insights that challenge conventional views on currency systems and economic structures. Below are the key points that highlight these counterintuitive findings. 1. Stablecoins as a financial equalizer. Traditionally, fiat currencies have been viewed as the backbone of national economies, but stablecoins are emerging as a powerful alternative that could democratize access to financial systems. While fiat currencies are often tied to the economic strength of a nation, stablecoins offer an opportunity for individuals and businesses in underbanked regions to engage in global commerce. This contradicts the idea that only state-backed currencies can provide stability and security in financial transactions. 2. Regulatory pushback versus innovation. The Genius Act aims to regulate stablecoins, which many might assume would stifle innovation in the cryptocurrency space. However, the counterintuitive reality is that clear regulatory frameworks can foster innovation by providing a stable environment for businesses to operate. As institutions become more comfortable with compliance requirements, they are more likely to adopt stablecoins for their payment systems. Thus, regulation could paradoxically lead to greater creativity and expansion in the fintech sector. 3. The role of trust. One might think that the inherent volatility of cryptocurrencies would make stablecoins less appealing. However, the reality is that stablecoins backed by fiat reserves can actually enhance trust in digital finance. Users are more willing to embrace stablecoins because they perceive them as safer and more reliable than traditional cryptocurrencies. This challenges the narrative that only decentralized and volatile assets can attract speculative investment. For geopolitical implications, the rise of stablecoins threatens to dilute the dominance of national currencies, particularly the US dollar. While some may view this as a risk to national sovereignty, it can also be seen as a catalyst for nations to innovate their own digital currencies. This could lead to a competitive landscape where countries are incentivized to enhance their financial systems rather than merely trying to maintain the status quo. The counterintuitive insight here is that the proliferation of stablecoins may ultimately lead to stronger national currencies through competition rather than their decline. 5. Financial inclusion versus centralization. The concept of stablecoins is often associated with decentralization. Yet the practical integration of stablecoins into existing financial systems may lead to increased centralization through major tech firms and banks that control the issuance and management of stablecoins. This creates a paradox where the push for financial inclusion via stablecoins could result in a more centralized financial ecosystem dominated by a few large players, contradicting the original ethos of decentralization in cryptocurrency. 6. Cost efficiency versus complexity. While stablecoins are touted for their cost efficiency in cross-border transactions, the reality is that their integration into existing payment infrastructures can be complex and costly. businesses may face significant hurdles in adopting stablecoin technology, including the need for compliance with a patchwork of regulations and the technical challenges of integrating blockchain systems. Thus, the expectation that stablecoins will automatically lead to lower transaction costs may overlook these complexities. 7. Consumer protection versus market freedom. The Genius Act and similar regulations aim to enhance consumer protection in the stablecoin market. However, there is a counterintuitive tension between consumer protection and market freedom. Stricter regulations may limit the types of stablecoins available, potentially stifling competition and innovation. This raises the question of whether enhanced consumer protections could inadvertently lead to a less diverse and more restrictive market. 8. Impact on monetary policy. The introduction of stablecoins could challenge traditional monetary policy frameworks. Central banks typically rely on the control of fiat currency supply to manage economic stability. The rise of stablecoins may dilute this control, leading to unforeseen consequences for inflation, interest rates, and economic growth. Therefore, the counterintuitive insight is that the success of stablecoins could complicate rather than simplify the task of monetary policy. 9. Legacy systems versus innovation. The assumption that established financial institutions will resist adopting stablecoins because they threaten traditional banking models is being challenged. In reality, many banks are integrating stablecoins into their operations, viewing them as a way to enhance their service offerings and maintain competitive advantage. This suggests that rather than being at odds, legacy systems and innovative technologies can coexist and even complement each other in evolving financial landscapes. 10. Cultural resistance to digital currency. While it may be assumed that consumers will quickly embrace stablecoins due to their advantages over traditional currencies, cultural resistance can be significant. Many consumers may remain skeptical of digital currencies due to a lack of understanding or trust in blockchain technology. Therefore, stablecoins may not achieve widespread adoption as quickly as expected, highlighting the need for education and outreach in addition to technological advancement. In conclusion, the discourse surrounding the Genius Act and stablecoins reveals numerous counterintuitive insights that challenge traditional views on currency regulation and the future of finance. As the landscape evolves, these dynamics will play a crucial role in shaping the integration of stablecoins into global financial systems, potentially redefining the relationships between currencies, governments, and consumers in the process. The report on the Genius Act and the rise of the US dollar stablecoin as it pertains to challenging existing legal currency systems and national forms contains several pivotal insights that are often overlooked. These insights are significant as they provide a deeper understanding of the implications of stablecoin adoption, regulatory frameworks, and the potential transformations in global finance. 1. Emergence of stablecoins as a payment method. While many discussions focus on the disruptive potential of stablecoins, the report emphasizes their practical applications, particularly in cross-border payments. The reduction of remittance fees from over 6% to mere basis points is a critical detail that underscores how stablecoins can democratize access to financial services. This is especially significant for individuals in developing countries who rely heavily on remittances. Understanding the real-world impact of stablecoins, such as providing faster, cheaper, and more reliable payment options, can shift the narrative from viewing them solely as speculative assets to recognizing them as essential tools for financial inclusion. This transformation could empower millions and reshape global economic structures that have historically marginalized certain populations. 2. Regulatory complexity and its importance. A common oversight in discussions about the Genius Act and stablecoins is the nuanced regulatory landscape. The report highlights the fragmented state of U.S. regulations concerning stablecoins, where issuers face a patchwork of state and federal laws. This detail is significant because it illustrates the challenges that issuers must navigate to establish trust and compliance in a rapidly evolving market. The potential passage of the Genius Act could streamline these regulations, but the complexities involved in aligning various political interests, as indicated by the legislative delays reported, reveal the contentious nature of crypto regulation. This detail is crucial for stakeholders in the crypto and financial industries, as it directly impacts their operational frameworks, compliance strategies, and market positioning. 3. The role of institutional confidence. The report points out the critical need for regulatory clarity to foster institutional confidence in stablecoins. This aspect is often understated in broader discussions. The importance of institutional adoption cannot be overstated. It is this confidence that will drive significant capital into the stablecoin market, enabling innovations in treasury management and corporate finance. The details regarding how regulatory frameworks can mitigate risks, build trust, and align stablecoin adoption with existing compliance standards resonate deeply with institutional investors. Understanding that regulatory clarity is not just a bureaucratic hurdle but a foundational element for broader adoption can lead to more strategic investments and partnerships within the financial ecosystem. 4. Integration with traditional financial systems. The integration of stablecoins into traditional finance is a theme that deserves more attention. The report discusses how payment service providers, PSPs, and banks are beginning to embed stablecoins into their operational frameworks, indicating a convergence of digital and traditional financial systems. This detail is significant because it suggests a gradual normalization of blockchain technologies within established financial practices, as payment firms begin to leverage APIs for seamless integration. The potential for stablecoins to enhance liquidity management and automate treasury operations becomes apparent. This evolution could lead to a paradigm shift in how businesses manage cash flow and financial transactions, making it imperative for financial professionals to understand the implications of such integration. 5. The impact of market fragmentation on adoption. Market fragmentation is another critical point raised in the report that is frequently overlooked. With hundreds of stablecoins in circulation, the lack of standardization presents a challenge for interoperability and trust. The detail about how this fragmentation complicates reconciliation and increases costs can have real implications for businesses considering stablecoin adoption. Recognizing the challenges posed by market fragmentation and the need for unified standards is essential for stakeholders in the financial ecosystem, as institutions seek to adopt stablecoins. Understanding the landscape will be vital for navigating the complexities and ensuring a smoother transition to a more integrated digital finance environment. 6. Potential for global financial transformation. The report hints at the profound implications stablecoins could have on global finance, especially in relation to the US dollar's dominance. While much attention is given to the potential for de-dollarization, the nuanced discussion around how stablecoins could either reinforce or challenge the existing dollar-centric system is often overlooked. The potential for stablecoins to facilitate economic activity in regions with struggling currencies could lead to a shift in financial power dynamics. This is significant not just for individual economies but for global trade practices and international relations. Stakeholders must consider how these developments could reshape their strategies in a world where stablecoin adoption becomes more prevalent. 7. The importance of transparency and trust. Lastly, the role of transparency and trust in the stablecoin market, particularly concerning reserve management and auditing practices, is a detail that cannot be ignored. The report mentions the importance of regular attestations and the potential risks associated with a lack of transparency. In an environment where consumers and businesses are increasingly wary of financial institutions, the ability of stablecoin issuers to demonstrate robust reserve practices will be crucial. This aspect ties back to the broader theme of institutional confidence. Without trust, adoption and usage will be limited. Understanding the mechanisms that build trust in stablecoin systems can lead to more informed decisions by businesses and regulators alike. Conclusion. The report on the Genius Act and the new East India Company sheds light on several important yet often overlooked aspects of the stablecoin landscape. From the transformative potential of stablecoins in cross-border payments to the complexities of regulatory environments. These insights reveal the multifaceted challenges and opportunities that lie ahead. As stablecoins continue to gain traction, understanding these nuances will be essential for stakeholders across the financial spectrum. The four most valuable points for in-depth analysis and discussion. The intersection of the Genius Act and the evolution of stablecoins presents a vital examination of financial systems, regulatory frameworks, and economic paradigms. Here are the four most valuable points from the content that warrant in-depth analysis and discussion. 1. Regulatory landscape and the Genius Act's implications. The regulatory landscape for stablecoins is evolving rapidly, and the Genius Act represents a significant legislative effort to create a coherent framework for the regulation of stablecoins in the U.S. The lack of a unified federal framework has resulted in a patchwork of state regulations that create uncertainty and operational challenges for businesses. Key discussion points. Impact on institutional trust. How can clear regulatory frameworks such as those proposed in the Genius Act enhance trust among institutional investors in adopting stablecoin technologies? Comparative analysis. Comparing the regulatory frameworks in the US and the EU MiCA provides insights into how different approaches could shape the competitive landscape for stablecoins globally. Consumer protection. What mechanisms within the Genius Act can help ensure consumer protection without stifling innovation in the stablecoin space? 2. Integration of stablecoins into traditional financial systems. Stablecoins are positioned as a bridge between traditional finance and digital assets, highlighting their potential to modernize payment infrastructures. Their ability to provide faster, cheaper, and programmable transactions is transforming cross-border payments and treasury management processes for businesses. Key discussion points. Operational efficiency. Analyzing how stablecoins can streamline operations and reduce costs in cross-border transactions compared to traditional systems like SWIFT. Real-world use cases. Discussing specific examples of how businesses are integrating stablecoins for treasury management and payments, emphasizing practical implications and benefits. Risks of integration. What are the potential operational and smart contract risks associated with integrating stablecoins into existing financial systems, and how can these be mitigated? 3. Challenges and risks of stablecoin adoption. Despite their advantages, stablecoins face several challenges, including regulatory compliance, operational risks, and reserve transparency. The successful adoption of stablecoins hinges on addressing these challenges effectively. Key discussion points. Regulatory compliance issues. How can businesses navigate the complex regulatory landscape, particularly concerning AML/KYC requirements, and what strategies can they employ to ensure compliance? Transparency and trust. The importance of reserve management and transparency in maintaining stablecoin pegs raises questions about how issuers can build trust with users and investors. Market fragmentation. With numerous stablecoins in circulation, how can firms ensure interoperability and seamless transactions across different stablecoins and blockchains? 4. The future of stablecoins in the global economic system. As stablecoins gain traction, their role in the global economic system is becoming increasingly significant. They have the potential to disrupt traditional monetary systems and challenge the dominance of existing legal currencies. Key discussion points. De-dollarization trends. Exploring the potential for stablecoins to counteract trends of de-dollarization and their implications for global trade and finance. Programmable money. Discussing the concept of programmable money and how stablecoins can enable new financial products and services, such as automated treasury operations and smart contracts. Long-term economic implications. What are the broader economic implications of widespread stablecoin adoption on national currencies and monetary policies? Conclusion. The interplay between the Genius Act and the rise of stablecoins signifies a transformative moment for the global financial landscape. By analyzing the regulatory implications, integration challenges, risks, and future potential of stablecoin, stakeholders can better understand their impact on existing legal currency systems and national forms. This comprehensive examination will not only inform policymakers and business leaders but also contribute to the broader discourse on the future of digital finance. 1. The rise of the East India Company 1600 to 1874. The East India Company was established in 1600 and became a pivotal player in British colonial expansion in India and beyond. Initially a trading entity, it evolved into a powerful political force, wielding significant authority over vast territories. The company's ability to establish a monopoly over trade in spices, textiles, and other goods fundamentally altered the economy of the Indian subcontinent and served as a precursor to modern multinational corporations. The East India Company's operations highlighted the challenges of regulating a powerful corporate entity, similar to the current discussions surrounding stablecoins and their potential impact on national currencies and regulatory frameworks. The eventual push for greater oversight and governance over the company's practices led to the British government's direct control of India after the Indian Rebellion of 1857. 2. The gold standard and its dismantling 19th to 20th century. The gold standard was a monetary system where a country's currency or paper money had a value directly linked to gold. Countries agreed to convert paper money into a fixed amount of gold, which ensured stability in currency values and facilitated international trade. However, the reliance on gold limited the flexibility of monetary policy and often led to economic instability during times of crisis such as the Great Depression. The gradual abandonment of the gold standard in the mid-20th century, particularly with the U.S. moving off the gold standard in 1971, illustrated how monetary systems could evolve in response to economic realities. This transition paved the way for fiat currency systems akin to how stablecoins are challenging the traditional currency systems today by offering a new digital alternative that may transform how value is stored and transmitted. 3. The Bretton Woods Agreement 1944 to 1971. The Bretton Woods Agreement established a new international monetary system after World War II, pegging currencies to the US dollar, which in turn was convertible to gold. This system sought to promote international economic stability and prevent the competitive devaluations that characterized the interwar years. However, the system faced challenges due to inflationary pressures and the growing imbalance in the U.S. balance of payments. By 1971, the U.S. could no longer uphold the dollar's convertibility into gold, leading to the collapse of Bretton Woods and the shift to floating exchange rates. The end of this system underscored the vulnerabilities of fixed currency systems and the potential for alternative forms of currency to emerge, much like the rise of stablecoins today, which seek to provide a stable medium of exchange without reliance on a traditional legal framework. These historical cases illustrate the ongoing evolution of monetary systems and the tension between regulatory frameworks and the rise of alternative currencies, shedding light on the potential implications of stablecoins in today's financial landscape. Future outlook: the impact of the Genius Act and US dollar stablecoins on currency systems. The emergence of stablecoins, particularly those pegged to the US dollar, is reshaping the global financial landscape. The proposed Genius Act aims to establish a regulatory framework that could significantly influence the adoption and integration of these digital currencies into the mainstream economy. As we look towards the future, several key predictions can be made about how US dollar stablecoins will challenge existing legal currency systems and national forms. 1. Regulatory clarity and institutional adoption. As the regulatory landscape matures, driven by initiatives like the Genius Act, we can expect a surge in institutional adoption of stablecoins. Financial institutions, payment service providers, and corporations will gain confidence in using stablecoins for transactions, treasury management, and cross-border payments. This regulatory clarity will facilitate the integration of stablecoins into existing financial systems, allowing them to coexist alongside traditional fiat currencies rather than completely replacing them. 2. Enhanced cross-border transactions. Stablecoins are poised to revolutionize cross-border payments by offering faster, cheaper, and more efficient alternatives to existing systems like SWIFT. As businesses increasingly adopt stablecoins for international transactions, we can predict a significant reduction in remittance fees and transaction times. This shift will not only enhance liquidity for businesses operating globally but also empower individuals in regions with less stable currencies, providing them with a reliable digital asset for transactions. 3. Programmable money and smart contracts. The future of stablecoins will likely see the increased use of programmable money through smart contracts. As businesses explore the potential of blockchain technology, stablecoins will facilitate automated payments, escrow services, and conditional disbursements. This programmability will enhance operational efficiency and reduce reliance on traditional banking processes, allowing for real-time liquidity management and seamless transaction workflows. 4. Competition with national currencies and central bank digital currencies (CBDCs). The rise of US dollar stablecoins may exacerbate competition with national currencies, particularly in economies facing inflation or currency instability. Countries with less stable financial systems may see increased adoption of dollar-pegged stablecoins as a means of preserving value. Moreover, as central banks explore their own digital currencies, the interaction between CBDCs and stablecoins will become a focal point of discussion. Governments will need to navigate the implications of private stablecoins on monetary policy and financial stability. 5. Increased financial inclusion. Stablecoins can play a crucial role in increasing financial inclusion, especially in developing economies. With a significant percentage of the global population lacking access to traditional banking services, stablecoins can provide a bridge to the financial system. By allowing individuals to hold and transact in a stable digital currency, these assets can empower underserved populations, facilitating access to global markets and services. 6. Challenges and risks to stability. Despite the promising outlook, several challenges and risks accompany the rise of stablecoins. Regulatory compliance, reserve transparency, and operational risks associated with blockchain technology will be critical factors affecting their adoption. The Genius Act aims to address some of these concerns, but the efficacy of regulatory frameworks in ensuring consumer protection and financial stability will remain under scrutiny. 7. Dynamic interaction with existing financial systems. Stablecoins will not operate in isolation. Their integration into existing financial systems will create a dynamic interplay between traditional finance and digital assets. Payment networks, financial institutions, and fintech companies will need to adapt to these changes, evolving their business models to incorporate stablecoin technology. This shift may lead to innovative partnerships and the creation of hybrid financial products that leverage both traditional and digital assets. 8. Global standards and collaboration. As stablecoins gain prominence, there will be a push for global standards to govern their use and ensure interoperability across borders. Collaborative efforts among regulators, financial institutions, and technology providers will be crucial to create a cohesive framework that addresses the unique challenges posed by digital currencies. This global approach will facilitate smoother cross-border transactions and enhance trust in stablecoin ecosystems. Conclusion. The future of stablecoins, particularly those tied to the US dollar, represents a significant evolution in the financial landscape. The Genius Act and subsequent regulatory frameworks will play a pivotal role in shaping the adoption and integration of these digital currencies. As stablecoins challenge traditional currency systems and offer innovative solutions to long-standing financial issues, their impact will be felt across economies, industries, and individuals worldwide. While opportunities abound, navigating the associated risks and challenges will be essential for realizing the full potential of stablecoins in the future financial ecosystem.